Thank you for joining us for another My Wealth webinar. Today's call is with Stephen Johnston, and he oversees the Veripath Farmland Funds. Steve has over 20 years of experience as a fund manager, both on the debt and private equity perspectives. And he's also was a senior fund manager at Societe Generale Asset Management in the UK. Stephen, it's a great pleasure to have you. We also have on the line Dave Townshend and Raheem Somani. They're senior investment advisors on the Townshend and Somani and Hunter Group at Canaccord Genuity. Today's call will be recorded, so check your emails in the coming days for the replay information. And with that, Stephen, I appreciate you coming on. Just provide a little bit more background of who you are and what Veripath does.
Sure. And I'm going to try and keep this to 40 minutes so that we have some time for some Q&A. So it's an abbreviated version of the main presentation, but you guys have it. If you want to pass it along for further detail for clients, please feel free. So first of all, minor correction. Now I have more than 30 years experience. It's like and I'm loath to correct you because I'm starting to now date myself, but in any event. So I've been around for quite a long time. But let's talk a little bit about Veripath and our farmland strategy. So we've been investing in farmland for 16, 17 years now. We were actually one of the pioneers of the asset class in Canada. And what I'll do is I'll just give you a kind of a general overview, and then I think there's some more specific components of the thesis that I think are probably worth touching on. But we've had 63 quarters of positive returns. And the highest quarter return was 5.8%. This is quarterly, and the lowest quarter was 2.6. And that return information is unlevered. It includes rents and land appreciation. So that's a very good consistent rate of return. I'm sure everybody on the presentation realizes. We manage currently about 125,000 acres. The AUM of that is about $400 million. I think the most important thing about the fact that we've been doing this for 17 years is that our approach to farmland is that we don't operate farms, and I'm going to go into that in a little bit of detail and explain why we don't do that. But because we don't operate farms, we've really been pioneers in the use of technology to monitor what's going on the land. We have proprietary satellite, artificial intelligence, agrology monitoring tools, land lease management tools. We've built a whole suite of proprietary investment screens and a proprietary portfolio construction model, which this combination of technology and expertise has allowed us to beat the Canadian Farmland Benchmark Index over the last 17 years consistently by about 30%. So, we've done really well. And, this is a very unique, and it's part of our competitive advantage, I would suggest. There's very few managers globally that approach the strategy from the monitoring side like we do. So let's talk a little bit more about that non-operated comment that I made. There's kind of two schools of thought for farmland investing. There is you own the land and you operate it. And then there's the approach that we take, which is you own the land and you rent it out. You don't operate farmland. And the reason that we chose that approach it wasn't random, and it wasn't because we were hesitant to operate farms. I mean, we have the expertise. It's because when you look at the volatility of farmland operations versus the volatility of land prices, the volatility of operations is 4 times higher than the volatility of land appreciation. And so the challenge when you own and operate is you pick up volatility. One year you make your operating profits are good, and the next year they're bad, but you don't get compensated for it. And so in aggregate, you reduce your risk-adjusted returns. And as investors, our primary focus should be on improving our risk-adjusted returns, the return versus the risk. And that's the reason we don't operate land. You get a very strong, compelling return profile, and I alluded to it in the first slide, by stripping out operations. You don't pick up any of that commodity price volatility. And that's important because you do not get paid for it. Now, I want to talk a little bit about that other thing I mentioned, which is an area where we are quite cutting edge, which is on the monitoring side. We have like three really big, I describe them as buckets to our monitoring. We have the satellite component, and we have farmer reporting, and we have agrology reporting. And I'll just deal with them, one by one. So during the growing season, we get real-time imagery of all of our fields. Every 160-acre field, we get satellite imagery. And without going into the specifics, it's a metric, it's data called normalized difference vegetative index, and that's in real time. And every field has this data through the growing season. And at the end of the year, we have machine learning tools that look at all those pictures and tell us what went on the land. It tells us crop type, tillage practice, cover crop, cultivated, uncultivated ratio. And in due course, as the data sets get bigger, you'll be able to do productivity, and other metrics will come with further data. And that's really important because we can now monitor our portfolio regardless of how big it gets, regardless of how geographically dispersed it is, with satellites rather than people. And this has only become cost effective in the last 3 or 4 years. 10 years ago, we were doing this with human beings. And of course, the challenge there is it's expensive, it doesn't scale very well, and it has inaccuracy. Now we've been able to migrate all our monitoring over to this satellite approach. And we're one of the probably only managers in Canada that does it this way. But the benefit is it's highly accurate, it's much less expensive, and it's scalable. As soon as we add a piece of land, regardless of where we add it, we can monitor it in real time. Now, and all this data dumps into our software data repository. Now, the second piece of the puzzle is at the end of every year, we get a farmer report. They log into an online portal and they fill out a report with a lot of detailed information about what took place on every 160-acre field that they rent from us. And it covers all the same metrics as the satellites, and then some additional things: herbicide, pesticides, applications, equipment passes, those kind of things. And then what the system does is it compares the AI report with the farmer report. And of course, what does that tell you? It tells you was there good crop rotation. It tells you whether the farmer says that they use zero till, and the satellite report says no, they tilled the land. I mean, zero till is the sort of sine qua non of good farming practices, and we can compare. So we can do crop rotation, we can do whether the cultivated uncultivated ratio is changing. All these metrics. And the beauty of this is the farmer provides the ground truth, puts this report in, the satellite compares it all without human intervention. So you can imagine, we have 125,000 acres currently. Through time, we'll get to 300,000, 400,000, 500,000 acres. And it would become an impossible task for human beings to do this monitoring, because you'd have to make all these comparisons manually. Our system, the data drops in and it does it all automatically. And so, for instance, if a farmer said, last year I grew canola and this year I grew wheat, they practice crop rotation. And the system said, no, last year you grew canola and this year you grew canola, it would throw an alert and ask for an explanation, because there wasn't good crop rotation followed. It's all automated. Now, of course, I just want to say something here about farming practices. We've been working with farmers for 17 years, and we've never had any problems with farming practices. Farmers take their stewardship very seriously, but our job is to trust but verify, and we do it with technology. And then the third piece of the monitoring system is that we select 10 locations on every 160-acre field. And every 3 to 5 years, we test those locations. The agrology team goes out into the field, they sample the soil, and they give us a lab report. And so that's, basically, you think about it, I think it's 23 metrics, 10 locations, 230 data points for each field. It's a 150-page report for each location. All of that data dumps into the system. And the system now can also track changes through time. like has the nitrogen content of the soil gone down, the organic matter, or has the pH gone up, or is the iron changed? And once again, all that monitoring is done uh, by the software systems. Because imagine if you were, if human beings were doing it, and we now say we manage 300,000 acres. These reports are, 150 pages long. You might have 1,000 of them. You have 15,000 pages to read and check. It's not possible. You can't operate a portfolio like ours and as big as ours will get and as diversified as ours will get without building all these systems. They're critical to implementing this strategy because you won't remember, you don't want to operate the land. You want to just own the land and cash rent it. And if you cash rent it, you have to be an expert in monitoring. And I would suggest that once you get beyond a certain size, you cannot do it any other way than this. And we've really pioneered the use of technology on the monitoring side. Just a little snapshot of what that looks like. Through the year, we get pictures. This is just the field. You can see as crops grow, they absorb different frequencies. The white is just the uncultivated. And there are pictures, like every single piece of land. These are just 160-acre fields, has these pictures. Now, all this data is electronically dumped into our land management system. And the other thing about this, which is probably more subtle, is that as we grow and as we hold this portfolio for longer and longer, because our funds are open-ended and evergreen, and they could, in theory, continue indefinitely, you start to collect this enormous series of data about every piece of land. And of course, that data independently has value, particularly to new buyers, but of course to us internally, because we can start to do analysis. So these are powerful tools from two perspectives: the monitoring and this, like the accuracy and the cost effectiveness of the monitoring, the scalability of the monitoring, but also just the intrinsic value of data. I mean, everybody on this call knows that we live in an era where data has, like, independently of the asset, has material value. And we've been very rigorous about collecting it. We collect the agrology data electronically through time. We collect the satellite data electronically through time. We have the ground truth from the farmers electronically through time. And that database will start to yield its own value and its own utility as we go forward. Here's just an example of one field, the heat maps for some of the variables. And you can see how, if you got enough of these, it's not possible for human beings to do this monitoring program. You need software tools. Now I just want to move on to a little bit about our performance, because I did mention that. Excuse me. So this is since inception, 2007 to 2022, Veripath's returns versus the benchmark. The reason we don't have 2023 is we're waiting for the Stats Canada Farmland Value Report to come out for 2023, and then it'll be updated. But so the Canadian benchmark return for farmland in that period was 9%. And we generated an 11.3%. It's important to note here that 11.3 is just land appreciation. It's unlevered. There's no leverage to generate these returns, and it does exclude fees. Of course, rental rates are 2, 3, 4, 5% on top of that, depending on where you are in the cycle. So you can see that we materially outperformed the benchmark. But I think I would suggest, probably more importantly, is the risk behavior. Remember, I mentioned earlier, like, as investors, you've got to focus on risk-adjusted returns. It's no good to get a really great return if you took a disproportionately high risk. And so that's really important. So we materially outperformed the benchmark, but we didn't change the risk behavior of the strategy. Like, we had low volatility, the same volatility as the benchmark. For those of you that aren't statisticians, we had positive skew, meaning we have a tendency to generate positive returns, no negative returns. And kurtosis just is the tails, meaning did you have strange, unique outliers? And we actually didn't. And just so that you can contextualize that return profile, over that period, we generated an 11.3% IRR with a very low volatility, standard deviation of 4%. If you compare that to the S&P was 11% with 4 times the volatility. The TSX small cap was 1/4 of our return with almost 5 times our volatility. And so when you're thinking about layering farmland into your portfolio, and of course you invariably are replacing other things. Farmland, if you look at it just purely through this lens, was a materially superior return profile to public equities. It's incontrovertible. It generates very consistent high returns with very low volatility. And so this chart here is just a visualization of our return structure. And so what you can see is we did what you would want your manager to do. We pushed the positive returns out. We captured more of them, and we clipped off the negative returns. We've never had a piece of land with a negative where we generated a loss. This is just I'm sure you will get the deck from the team, but now this is our quarterly track record, quarter by quarter by quarter by quarter, and you can see what I showed you. And this excludes leverage, which is really important because a lot of the returns you see generated in the alternative space disguise the fact that they were generated with a lot of leverage. And of course, leverage, if everything's going well, leverage is a return enhancer. But as soon as things go slightly badly, leverage, conversely, is a loss magnifier. So we generated all this return, all these really good returns, and without leverage. In fact, in all of our historical funds, the first 6 funds that we had, which were closed-ended, we didn't use leverage at all. And even today, we still keep a modest loan-to-value of about 25%. We want to take advantage of all the good characteristics of farmland, and we don't want leverage to be our return driver. It's because, if your only return driver is your willingness to be more levered than the asset class and more levered than your competitors, invariably that doesn't work well over the long term. So now I'm going to talk a little bit about, the more broad elements of the farmland investment strategy. Now this is quite a detailed section, and I won't go through all of it. I just want to touch on a few things today, and if there's any follow-up questions, of course, I'm happy to deal with them. But when you think about farmland, ignoring that it's farmland and ignoring, any, sentimental views you might have about farmland, farmland is just a non-depreciating machine. It's the only non-depreciating commodity production asset on the planet. So it's a non-depreciating machine that is producing an infinite series of crops, all of which are consumed. That's its core characteristics. It's very unique. And so when we think about the strategy now, that sort of has consequences for, the big picture. So what are the sort of big things that are driving the farmland investment strategy globally and then specifically in Canada? So what's generating returns? So first of all, it's macro. It's just absolute population growth. By 2050, there are going to be an extra 2 billion people. And then by the end of this decade, there'll be an extra 1 billion middle-class people. That has a very profound effect on demand for agricultural commodities. And in fact, if you look at just the forecast for 2050, the global agricultural output has to double. And given that there isn't any additional land really that can be utilized, that all has to come from increasing productivity, and that's very difficult to achieve because there's only so much fertilizer you can apply, there's only so much water, there's only so much sunshine. Plants can only be improved so much through genetics. So that'll be a very challenging target to hit. And of course, when you have demand outstripping supply, you have price increases. The other macro driver in the farmland space, which was kind of always one that we liked, and we analyzed the data when we got into the investing in farmland in 2007, but we were just never expecting to see this set of conditions materialize. But is inflation, or more importantly, stagflation. If we continue, I would suggest we're in stagflation. If we continue with this period of stagflation, farmland is one of the few assets that really likes stagflation. And I mean, when you think about it, it's intuitive. It's a real asset. It's a non-depleting, non-depreciating commodity assets, so it likes inflation. And it likes the stagnation piece because in a recession, people don't change their diets. They may make many other concessions, but they continue to eat. And so it's very resilient in stagflation. In fact, I'm going to show you the data. It outperforms. It's really good stagflation insurance, and it's really good inflation insurance. Now come over to the portfolio piece, because regardless of the macro, when you're making an investment decision, you're putting an asset into a collection of assets. And so the question you always have to ask, and I'm sure your advisors, work with you on this, is how does this investment work in conjunction with everything else I own? Because that's important. And the thing about farmland is it has some really useful portfolio benefits. First of all, it genuinely diversifies the outcomes. I mean, it shows very low correlation to other traditional asset classes. It reduces portfolio volatility, meaning, if you make an allocation of farmland, your return profile shouldn't be as volatile. It preserves capital. Farmland has very few down years. It's a quarter as many down years as the public equity markets, and they tend to, on average, be very small. So it preserves capital. And finally, it hedges recessions, and that's actually there's a limited universe of investments you can make that hedge recessions well. Then the third return driver, which is now more relevant for Canada, is that there are material mispricings of farmland in Canada. That's just a very complicated way of saying that farmland in Canada is inexpensive. There's a value proposition. The other return driver, which we try to incorporate into our portfolio, is change of use. You can change dry land. In Canada, we have 3-4% of all the farmland is irrigated, which is quite a low percentage. But we have a lot of land that can be irrigated, and you get a very large jump in the value of the land if you change the use from dry land to irrigated. And so, just by way of example, in the last year, we bought $60 million of irrigated land. It was half irrigated, half dry land. And, over the course of time, we'll convert the rest of the dry land into irrigated land. And on average, at current prices, you go from about $3,000 an acre to $14,000, $15,000, even higher $1,000 an acre once it's irrigated. And of course, there are capital costs, but there's a very large value pickup. And of course, the third return driver in any strategy is the manager. But I've talked a little bit about us and technology, and I'll talk a little bit about us later. But I want to focus on those three. So I want to talk a little bit about inflation and just how good of an inflation insurance policy farmland is, and how good of a stagflation insurance policy farmland is. So during the 1970s, which was the last bout of elevated inflation, we had a stagnant economy. It was one of the first modern experiences with stagflation. Stocks, bonds, and real estate at the end of the decade were down. It's actually a bit of a misconception. There's this. I think it's a slight misunderstanding. It's because it's a bit of a nuanced concept. There's this idea that real estate and stocks hedge inflation really well, but it's actually, there's a slight permutation. Stocks and real estate hedge low levels of inflation. Excellent. They do it very, very well, very, very effectively. But volatile levels of inflation, like where inflation goes up and then it goes down and it goes back up, like we're experiencing and like we experienced in the 70s, does not hedge inflation at all. And it's seen by the data. Those two asset classes were down at the end of the decade, and they experienced enormous volatility. Here's the S&P prices, up, down. That's the volatility I'm talking about. Farmland, on the other hand, experienced none of that volatility. It's the red line. It was just very consistent high returns, no down years. I'm sorry, I'm going backwards. So what you see here is this inflation hedging asymmetry, or this stagflation insurance policy. Canadian farmland in the 70s went up over 400% in nominal terms. and it went up about 275% in inflation-adjusted returns, meaning after inflation. And here's farmland, here's inflation, and then here's stocks, bonds, and real estate. So if you were trying to hedge all this risk, this is a nice characteristic, because it's hard for any of us to say, is stagflation a 2-year phenomenon? Is it a 10-year phenomenon? Will it go away tomorrow? Who knows, right? And so farmland's this asymmetrical return profile, if you in the 70s made like a 5 to 10% allocation to farmland, you hedged all of that risk. You hedged all of the risk, the inflation risk in stocks, bonds, and real estate. And this is actually a really, really important quality, because a lot of the reason why we get institutional investors coming to us to talk about farmland is, they like the other behaviors and they like the macro. It's interesting. But imagine if you're a pension plan and you have $200 billion and you're in a traditional, 60-40 portfolio. And you've had no inflation for 30 years. You're not prepared for inflation at all. How do you adjust your portfolio, which is hundreds of billions of dollars? How do you adjust it to hedge that risk? It's very difficult. So what you're looking for is very high, very asymmetrical payoffs to that risk, and farmland's one of them. And the reason we continuously are in discussions with institutional investors is because of this, because they can make a small allocation and get a lot of protection. And I would suggest that the way they're behaving and the risks they're considering, you should consider. Because if we do get a period like this, a traditional 60-40 portfolio will generate material losses, nominal and real. And you don't have to make a massive change to how you're configuring your portfolio at the outset to start hedging that risk. And farmland's an asset that does that really well. Let's talk a little bit about correlation, because correlation is one of those things that everybody promises. Sorry, I shouldn't say that. It's a very common promise that fund managers say, my strategy is uncorrelated. In fact, it gets said so much it's a cliche. I know I see Jeff smiling because he knows, right? And it's the truth. I'll admit it. Everyone says it. And what they usually will show you is, here's our 20-year correlation track record, and it's uncorrelated. But actually, that hides something that's actually more important, is because what you care about as investors is not how it behaves over 20 years. You care about how it behaves instantaneously. And what I mean by that is, you care about the correlation when there's a financial event. And it's invariably when there's a financial event that everything becomes perfectly correlated and your portfolio is not diversified and your losses are magnified. The one nice thing about farmland is it has very low correlation to traditional asset classes, but it maintains that lack of correlation during market events. So we've been at the strategy for long enough now. We've been through 3 financial events, and it had no impact on farmland prices. And so that's the important lack of correlation, is just those rare market events. You don't want your uncorrelated strategy to suddenly become correlated, because you get no portfolio benefits. And I apologize if this is perhaps a bit abstract, but I think it's important, because what a lot of people experienced was they were built, and this is why alternatives have become, of interest to everybody in investing, is this correlation feature, is that they built these portfolios that were allegedly diversified. There's a market event and everything goes down and stays down. And so why bother being correlated? Why bother going to the extra expense of having multiple investments, right? So the instantaneous correlation is something that you need to know, and I can assure you that farmland's correlation is low and does not change.
I just want to in on that. Just when you are dealing with it and your emotions are involved and there's a market event and there's tons of negative news coming around, if you can reduce those drawdowns and have things that are unaffected, you can be in a position to make better investment decisions. It calms things down quite a bit. Everything's in perspective. If everything's moving all in the same direction all at once, even if it's on the upside, poor decisions are made. So if you're making money too quickly, you get greed kicks in and it goes the other way with fear. And so part of our job is trying to go from point A to point B in the smoothest possible way. And things like this are very helpful for doing that because they do actually provide that negative correlation. So things can be a little calmer during the storm.
Yeah, I mean, if you don't mind me digressing, and I apologize, I my experience is that the correlation actually generates more damage on the upside, because what you see is everybody's doing extremely well, and all the underlying strategies are doing extremely well, and then they start to lever, and they get more and more and more levered, the managers, and then of course there's inevitably some market event, and then you typically find there's a market event when everybody's the most levered and does the most damage. It's one of the reasons why we're very rigorous about, even like we've had no drawdowns in 17 years, but we've still resisted the urge to run a lot of leverage, right? And that's discipline, right? Because you can, I would suggest, artificially increase your returns with a lot of leverage, because of course the consequences of the investors and the benefits of the managers, right? And so we just don't lever. And can I talk about leverage? Because I think it's part of why this sector has behaved so well and is, I think, going to behave well in relation to other things in the market that aren't going to behave well in the next decade, is leverage. And so one of the things that we really liked about farmland when we first started looking at it was that the asset class doesn't have a lot of leverage. And so we could, as managers, we don't like leverage. And so we didn't have to be leveraged. So you look at the sector leverage in farmlands, about 15 to 20%. Now, if you go to REITs, the leverage is 7 to 80%. So the reason why farmland isn't sensitive to interest rates is because the sector doesn't have a lot of leverage. And so you can ask me, what happened to farmland prices when rates went up? Nothing, because it's not a levered asset class. So I am running behind, and I apologize, but I want to talk about this, and then we'll talk about something I think which is unique about us and unique about our focus. This is 68 years of data. So it's the S&P versus farmland. And there's a lot of stuff here. So this is the up-down profile, meaning what's the average, how many up years, how many down years, the average size of an up year, the average size of a down year. And it goes to what you were talking about, Jeff. So the S&P had 53 up years out of 68, and they're big. On average, they're quite big. But it had 15 down years. So like 1 in every 4 years is a down year. And the average down years are big. It's that correlation problem and the volatility problem. Now go over to farmland. Farmland had 61 up years. So like now only 1 in 10 years is a down year. But the down years are very small on average. They're only about 4%. So you have very few drawdowns, and they're very small. So they're easy to recover from. And mathematically, what this translates into is farmland generated the same annualized returns as stocks with 50% less volatility. So you can use farmland as a public equity replacement. I mean, now there are other reasons to invest in public equity markets. There's value and there's strategy and there's industry selection. But just, the sort of generic invest in the S&P index, farmland can replace that investment, generate the same returns, half the volatility. Like that's a very compelling feature, and particularly the small size of down years. They're very infrequent and they're small, because this is something I always find slightly objectionable. Is people go, invest for the long term. If you invest in 100 years in the S&P, you're going to generate this return and this volatility. The challenge is, if you're investing for retirement and you happen to need your capital in the year where the S&P is down 13%, you crystallize the loss. Like, volatility isn't costless. It has a cost. Now imagine if you had the same investment in farmland as a down year, it's 4%. Basically, it takes a very short period of time and you recover the losses. So that's not a trivial thing. Like, volatility isn't an abstract concept. It's a cost. If you need your capital, it's a material cost. I think it's just obvious on the face of it. If you can generate the same return with less volatility, you should. And this is almost 70 years of data that farmland behaves like that. And I want to talk. I'm alive to the fact that I did promise to allow some Q&A. So I want to talk a little bit about how we approach things, because I'm a big believer in the idea that, if you identify a good investment thesis and it has good return profile, the area then you should really spend a lot of time focusing on is mitigating risk. Because if you can strip out risk and not impact the returns, you really magnify that risk adjusted profile of the investment, right? And so we have a very risk centric approach. So what are the risks in farmland? Well, it's weather, it's what you pay for the land, and it's farming practices. You want the land to be farmed, not mined. And so we've spent a lot of time thinking about this and building tools and an approach and processes to mitigate this risk. So on the weather risk side, we are measuring weather risk. We're measuring historical productivity trends and historical productivity volatility, meaning good weather, bad weather, good weather, bad weather. And that is a really elegant and simple way to measure weather risk, because those metrics are impacted by weather. We have enormous geographic dispersion. I mean, Canada is the second largest country in the world. We're spread across Alberta, Saskatchewan, and Manitoba. We're looking at a bit of land in Ontario, though it's expensive. So you get enormous geographic dispersion, which is another way to mitigate weather risk. And of course, we're non-operated. So in the short term, weather doesn't impact us because the weather impacts the farmers' operations and they have crop insurance. So we are obsessed with weather risk. The other thing is valuation. Like, no strategy can overcome poor investment decisions. Like, you have to capture value. You have to be sure that you're making good investment decisions. And we have spent a lot of time and energy, and it's probably for another call, building a set of investment screens and factors that go into building our portfolios. But the critical one is the price for a ton of wheat growing capacity. And we're ruthless about that. That's why we have no land in Ontario, because it can't get through this screen. And so when you think about farmland's a machine that properly maintained lasts forever. And so you want the price for a ton of wheat growing capacity to be the lowest possible. And globally, in the developed world, the price for a ton of wheat growing capacity is about $6,000 a ton. And in Canada, it's about $3,000 a ton. In the prairies, it's about $2,400 a ton. And in our portfolios, it's about $2,000 a ton. That's the reason we beat the benchmark, is because we optimized that variable. We captured more of that discount. The other things that go into mitigating valuation risk is we weight the provinces by Sharpe ratio. We weight the provinces by productivity volatility. There's a whole bunch of other variables, but it's that. You want to mitigate valuation risk, get the lowest price ton of productive capacity with the lowest historical volatility, with the most positive historical productivity trend. And it's the reason we beat the benchmark. It's the reason we have such low volatility. It's the reason we've had no drawdowns. And then finally, farming practices. You don't want to operate land. Like my dad's a farmer. Trust me, there's an old joke. Farmer is rich once in his life when he sells his land, right? And so, but if you're not going to operate, you have to be an expert at monitoring, and you have to do it inexpensively and accurately. And we honestly we're cutting edge in this area. Like, we have satellites, we have artificial intelligence tools, we have ground truth from the farmers. We're doing consistent agrology through time, testing all the same locations. All that data is electronically analyzed. And of course, on farming practices, we don't just have a single farmer farming all our land. We have, I think it's now 60 farmers. So we have diversification of operators too. And the last thing about how we approach it, we don't use leverage. We use leverage to manage cash. because the buying season is spring and fall, but we do monthly closings. And so leverage in our view of the world is more a tool to smooth out cash, like to eliminate cash drag, than to drive returns. Because I can assure you that there always comes a moment in every strategy where if you're over levered, you regret it. And you already, as investors, have your own leverage. You have houses and you have cars, and and so by us going, just operating at the level of leverage that allows us to manage the cash drag the most effectively and eliminate that from the return profile, you can choose your own leverage outside of our fund, and you don't have that, sort of embedded risk. Like I look at there are real estate strategies out there that are operating at 80% loan to value. I wonder how they're doing when rates went up 500 basis points in 12 months, right? So we've like, our valuations, and we have quarterly valuations based on third party appraisals. None of that had any impact on us because the asset class isn't levered and we're not levered. I mean, I a few years ago not many years ago, had more hair and it was darker. Like we focus on risk. Like if you have a good strategy and you do it well and you have good execution, if you focus on risk, like it's the place to spend your time. Anyway, sorry, I promised to allow some time for Q&A. That's basically it for today. This presentation is much longer, and I'm sure that the guys can send it out to you if you're interested. But if anybody's got a question, I'm happy to answer it.
Yeah, we have a couple so far, and for those on the call that want to chime in, there's a Q&A button in there. If you type in there, I'm more than happy to ask Stephen on your behalf. The first question is, how does prolonged drought affect land valuation? And then second to that, if the agrology sector does grow, why would the land appreciate?
So I'm not. I'll maybe get some clarification on the second question, but I mean, if like we diversify weather risks, so we're geographically diversified and we measure weather, right? So we have like a 10-year snapshot of the trend. So is productivity volatile or is productivity trending down? And that captures drought risk. There's always a drought somewhere, but we're measuring weather very well. Like if an area is trending down, that tells you something about the weather. It means it's getting drier. We avoid areas like that. It's not to say that we don't sometimes have areas with drought, but that's a natural part of farming, and we're geographically diversified. It's one of the reasons you should invest in a fund, is because if you buy a single piece of farmland, you can't diversify that risk. But we are measuring it, and we're trying to minimize it. Now, the risk that you can't mitigate is if there was a 10-year drought and it covered all of Canada. That's impossible to mitigate, right? So, but that isn't something that has happened in, I don't know. I think the last time there was a drought of any significant scale like that was in the 30s. But we do measure weather very carefully. So on the agrology, can you just maybe elaborate a bit? Because maybe I misunderstood the question.
I'm just reading from it. I'm assuming it's based on maybe if things are getting warmer and we're getting more land.
Oh yeah, so that's interesting. So what you do see in Canada, and you'll see if you look at our portfolio map, you'll see we now have areas up north. And what you're seeing actually is, and I don't want to get in. When you talk about climate change, it rapidly becomes a political discussion, and nobody's happy. So let me just say this: the IPCC says that northern latitude farming in Russia and Canada will experience productivity gains from global warming. And we do see crops moving north. And we do see so you see like crops that require a lot of heat, corn, et cetera, moving north in Canada. And that can have an impact on land value. It improves it. So yeah, I mean, that impact is there in the Canadian market to some non-zero extent. I can't tell you why it's happening, and I wouldn't try to. But I mean, the way we screen for land captures it, because we're screening for productivity adjusted pricing, the historical volatility, and the trend. And so if the weather is improving in a place and allowing greater productivity, we pick it up in the historical data. And we also screen areas like that. And now we have started to build our portfolio up in the Peace Country, right? So, yeah, I mean, but I won't. Yeah, how about that?
Can you speak to the type of operators you rent to, size, crop type? Uh,
Yeah. So we don't stipulate what crops they grow, other than that they use proper rotation. Now, the kind of operators we're working with typically tend to be like people who maybe have 5,000 acres of their own and rent 5,000 from us, or maybe sometimes even more. I think we have some. Excuse me. I think we have some leases that are bigger than that. But it's a mix. Sometimes if someone sells and they continue to farm, like the market in Canada isn't very corporate. Like this, it's still mostly like if you want to use a business, it's like small medium enterprises. There aren't too many massive corporate farms in Canada. So we're kind of renting to the typical cross section of farmers. Now we do checks on them, and we're making sure they pay. And in fact, one of the things that we did early on was we get paid 100% upfront on our leases. We don't take the risk of a fall payment, because if you take the risk of the fall payment, you typically won't get paid that because it was a bad year, and it allows operational risk to come into your returns. So that's a good screen, because it's usually only well-capitalized farmers that'll pay you 100% upfront, but that's basically across our entire portfolio. And as far as what they grow, if you looked at our portfolio in any one year, and we could tell you exactly because we have all the satellite imagery and the AI reports, like the average crops in the prairies would, and this is just 30% canola, 30% wheat, 30% barley. These aren't right numbers, but and our portfolio would look exactly like that, because it's just big enough that it just represents what's being grown in Western Canada. What we're focused on is proper crop rotation, but we've never had a problem with it in 17 years. Now, did I answer the question, or?
I think so. Well, I just try and get through some of these before we hit our end. You showed 3.5 to 5.5% quarterly returns in the early part of the presentation, without consideration for rental value. Where does the return come from? Is it unrealized from land value alone?
No. So this return series is rents and land, and it's every single piece of land we've ever owned. So about half of this data is land that we've owned and sold. And then in recent years, we haven't sold the portfolios, so we still own it. But the valuations here are based on third-party appraisals. So in Veripath, every quarter we strike a NAV, but that NAV is based on a third-party appraisal. We don't come up with the land value ourselves. But this return profile is rents and land appreciation. And the rough proportion of like how much is rental return and how much is land, it depends on where you are in the rental cycle. But let's say it varies between rents are about 25% of the return to rents are about 35% of the return. It just like rents tend to lag land prices by about a decade. So it just varies through time, but that's roughly how it's composed. And so when you look at Veripath's return track record, in the early days, we were generating extremely high returns because we were screening for this productivity discount. And in Saskatchewan, the price for a ton of wheat growing capacity was 1/20th of the global average. And so we invested all our capital there and it generated enormous returns because it was just a huge arbitrage possibility. Now, fast forward, the average in the prairies, and I said, is about $3,000, $2,400 a ton. So the differential is still quite large, but it's not as large as it was. So, but we're still generating gross like rents and land appreciation about 12%, and then you net off fees. And we of course have a little bit of leverage which pays for some of the fees. But the guys will have our actual net return series. You can see it by quarter by series for Veripath, and it's the series W3, which is the one I think that is available to you guys, is been averaging about 10% return net of all fees. Now remember, and it's really important to remember this. That return profile was generated with very low volatility, with very low leverage, with really good behavior. And it's still, I would suggest, very good. but it has some extra features that I think we need to pay attention to.
Finally, I think we should end it off on this one, just because of time considerations. Um, One of the reasons that we looked at you guys and went further and moved ahead was your guys' history and lineage and connection to farmers. Um, how does that blend in, and what is your long-term strategy for growth and land purchases for Veripath, and what is your targets per year and acres?
Yeah. So, I mean, we do have a long lineage. I just saw a recent report by some agriculture consultants. There are only 50 farmland managers in the world who've been doing it longer than 15 years, and we're one of them. And so first of all, we have really deep relationships in the farming community. We're considered a good partner to work with. Now, as far as what we planned, historically we ran closed-ended funds. They would start, they would invest, and then they would wind up. So Veripath is open-ended, so it can run forever as long as investors are interested. And so today we have about 125,000 acres, 400 million of AUM. At the end of this year, I think that'll be about $500 million of AUM. It'll probably be, depending on where we buy, it'll probably be another, let's just say 25,000 acres. And then the goal is to, in the next 3 to 5 years, is to get the portfolio up to, like, we can because of the way we monitor, we can manage a portfolio of any size. But I would forecast the portfolio gets up to in excess of 300,000 acres, and that would probably be approaching like $2 billion. Like, we're in a period of quite good growth because, first of all, the strategy is very timely for what the macro conditions. And there just aren't too many managers with our kind of track record, so it attracts a lot of institutional capital, and that tends to make you grow faster. And we have, like, the Canadian market is the value of the Canadian. This is something actually we're talking about. Like, the market cap of Canadian farmland is about $1 trillion. It's about half the size of the Toronto Stock Exchange. And if I said to someone, "Are you invested in the TSX?" they would go, "Yes." And if I said, "If you're invested in farmland," they would go, "No." But it's half the size. I mean, it's an enormous market. And so it is absolutely possible to get a fund well in excess of that size. The market is liquid. The market is big enough. There's deal flow. That's an important consideration.
Perfect. And Stephen, I appreciate your time today. For those that are on the line, feel free to reach out to myself, Raheem, or Dave. Happy to answer any questions, talk further at you, and see how it can be a fit. And with that, enjoy your Masters Thursday, and appreciate everyone sharing their lunch hour with us. Thanks again, everyone.
Bye-bye. Thanks.